This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
I want to show you something huge on gold, and it could pose risk to the dollar, but I'm going to tell you why it's not. I'll just remove this so we can get a clean chart and go out to a weekly. That's right, the big dog. Oh, you know what? I hope it shows up here. It's not going to. Anyway, I have a different commodities feed that I have where I track gold and some other commodities. There is a giant, just imagine a shoulder here. Oh, I guess it won't let me do it because there's no candles. Anyway, this is the second shoulder right here in a giant inverted head and shoulders. Now, when a head and shoulders pattern is inverted, okay, that means the opposite should occur from when it's an upright head and shoulders. Upright head and shoulders is a bearish pattern, so this is a bullish pattern. We've also got this symmetrical triangle that's forming, and it's not quite symmetrical, in fact, because the angle on the bullish line here on the bottom piece of the triangle is a bit steeper, right? If you drew an angle like this angle is greater than this one would be, right? So it's a little sharper. It's not quite geez, I can't even think of the name. An ascending triangle. It's not quite an ascending triangle. It's more along the lines of come on, Scott. Symmetrical. But it's also really part of a big flag pattern. And a flag pattern is bullish, right? Here's your flagpole, got the straight up move, or a pennant formation, not a flag. Jeez. I need another cup of coffee. So we've got this pennant formation, and I feel like we're going to blow the lid off of this. I mean, now we've got two things at play. We've got the inflation story, which is always good for gold, and I think the risk aversion story is almost back in play. Now, I don't know if gold needs a bigger retracement, and I know months ago I told you at some point this year I think we're going to get a breakout to $1,100, $1,200, $1,300 an ounce even. I just didn't know when it was going to come, and I think we're on the brink of it. So I am looking in the near future to be long gold, which is generally bad for dollar, but like I said, there's a caveat as to why it may not necessarily be. And it might take, see, this is the thing. This is going to be a bigger picture play for me. But it is something that I intend to participate in. And again, I don't know if gold needs to come back down and test 900. In fact, great, I hope it does. The one thing I don't want to see is breaking this pennant, because that would be not so bullish, obviously, if we broke out to the downside. And the other thing is, as we get closer to what they call the apex, where these lines meet, the weaker the breakout is supposed to be. Whereas if you break out within 62% of this move, meaning from base to apex, you want to break out somewhere in this vicinity where we are now to get the stronger move. And that's why I'm thinking we might be on the verge of it, because now you've got a second wave of risk aversion possibly coming through, like Dom just pointed out with the Chinese markets down 4.3% last night. I think U.S. stocks are ready for a pullback, whether or not there's one little more, like I said, blip on the radar leg higher. And then you've got the inflation story. So two good stories for gold. The reason it might not inevitably sink the dollar if gold does rally that far, we've seen gold and the dollar rally together before. They're generally competing currencies, but when it's risk aversion driving gold higher, risk aversion is also a dollar positive. And on the inflation front, sure, I mean, we're contributing to the inflation, but so are other central banks. We're not the only ones printing money. So it's really, I mean, we've got a bunch of fiat currencies that are backed by nothing, meaning we're not on a gold standard or anything like that. That's fiat currency. And most of the central banks are participating in quantitative easing. printing money and flooding the economy. So we're not the only offenders by a long shot. So that's maybe why dollar won't do so bad, even if gold does break out of this pennant and shoot to the moon. And I hope it does, because I want to participate in it. I think it's got some real potential here. So I thought that would be a fun chart to share with everybody. All right, last chance to get a question into to me. It's Scott Norris here. Well, I guess that's going to wrap it up then. Just a couple minutes to the top of the hour. Oh, Dom says, to get the missing candles to fill in on the left, I place the cursor on the leftmost candle and then hit the left directional arrow on the keyboard. Really? I'm trying. Do I have to click and hold? That's interesting. I thought it was because this data is provided by FXDD, and they only started offering gold last year, so that's why they don't have the charts, because they didn't offer it as a trading possibility now. But if you didn't realize that you can trade gold through your AI software or through FXDD's platforms directly, the symbol is XAUUSD, and it's at $936 an ounce today. And the spread's not bad. It's like 60 cents. I mean, 60 cents on $935. And to be able to trade gold at a leveraged, in a leveraged position is awesome. And it's not a futures contract. It's just straight up spot. So, all the best. All right, thanks for joining me. Hope you enjoyed the program. I'm Scott Norris. I'll be back with you at 1 p.m. today for the Forex Alert Show. Thanks. Take care.